But thanks for making time to come and hear a little about venture debt. Normally, I have to give like a point of view on something that's like not in like the core competency of what SVB does. But that's really why we exist. Is this concept of venture debt. And you guys as SaaS builders, just so I get a feel for like what your particular roles are and stuff like that. Can I get a show of hands of who's in like a BD or sales role? Just get a quick show. Okay. How about anyone in like product development? Product management, yeah, product management, okay, cool. And then any technical implementation, dev types here? Okay, good, I can skip the, skip the geek speak. So, I guess the chance to come and talk to you guys, met with, Sunir and Stephen Larson, and just heard a little bit about what the Cloud Security Association was doing, and just see this as an opportunity to kind of get in front of you guys and share with you how we can be an enabler on your journey. So as people that are trying to sell SaaS, build SaaS, and just kind of take advantage of the market, we're here to help. Okay, so that intro was perfect. Thank you, way too flattering. I've got some a combination of materials that we've got from kind of standard issue slides about the bank. Normally, again, I'm not going to try to be, I don't want to be an infomercial. Think of me as kind of more of an educated guide to do some, I'll talk about some things, but if something really speaks to you, just feel free to like wave your hand and ask a question. I should try to talk for about 20 minutes. I've left some time for questions and answers. And going to cover a couple things that might actually affect your ability to engage a bank like SVB for venture debt. I think in this era of increased data sensitivity, there's a lot of risk out there that if you guys are looking to get venture debt, bankers are going to want to know how you've got the financials covered, but there's also this kind of product risk. And when you're selling this kind of stuff, I've actually given a lot of talks on like how to sell to banks, because we're terrible clients. And so if anyone wants to hear more about that, I can double click into that as well. Financial fitness factors, getting everything in order before you actually go and talk to a banker. It's a great way to almost have a more friendly pre-investor conversation, because the bank is just, we have a different appetite. We aren't as going to be in your like the nuts and bolts of your technology, and more about kind of your business model. And our bankers are amazing at helping kind of guide companies through the different growth stages. Quick show of hands, who's in like a pre-Series A mode? Anyone work for a really tiny founder kind of startup? Okay, cool, good. That's where I spend most of my time. And yeah, actually, this is great. So I love founders. So that's cool. So I'll angle this as a way to kind of tell you from kind of the start of the journey up to kind of the, where you get into more things. So I'm going to whiz through these in about 3 minutes. These are kind of the SVB-esque slides for reference. Now, we exist as a bank because we loan to technology companies that innovate. So that's like this room. And thank you for helping pay my bonus this year. I think $7 billion of our loan portfolio is in software, and I'm willing to bet about 90% of that's SaaS-backed companies. So we do things to help companies on their way from early stage. We just kind of we deployed, I want to say $20 million into our early stage portfolio, which is a group that I work with very closely, and work with some folks in this room around that as well, and other companies that are here to help really at that earliest stage come in and give access to credit for early stage SaaS builders. And we scale up to do kind of more international and complicated treasury management. That's where if you're in a larger kind of SaaS arena, we may be using your product, or companies like us. I'll talk a little bit about the regulated space, because when you get into treasury and real CFOs, it's a topic. A lot of stats, a lot of background on what we do. I think some KPIs here that I'm particularly proud of is we really do bank half of the US VC-backed tech market. So that's a real stat. And we do have, I think, a network par none. So when you get into a network, we're really motivated to kind of help you guys succeed. And we're always looking for new startups to be that next acquired company, to be the next IPO, that kind of thing. So we're in your corner. Globally, I should add a little shout out to Toronto and Canada. We just got our branch license up there, so we can issue debt in Canada now, which is a big thing. And we're looking north to kind of engage clients more deeply there. But you can see we've got global presence. Israel has been a long time fortress for us in terms of good, especially SecTech, amazing security cyber technologists coming out of there. And you can see some of our global reach. We've got a joint venture in China with Shanghai Pudong Development Bank, so we can kind of help with a lot of kind of currency exchange between China and the US. That's kind of a sweet spot for companies looking to either expand to Asia or kind of coming from Asia to us. Okay, anyone else having an Econ 20 flashback? Because I know I am. I looked at this is like a slide that we use just to explain how venture debt actually works. And it's not that complicated. I think there's a lot of mysticism around how it gets priced and the factors that are involved. But its purpose is pretty simple. It's really to extend your runway. And right now, this assumes kind of a nice linear burn rate, like you're burning and spending exactly what you're supposed to spend. That's never going to happen. So it's more of like throwing a stone. And I like to think, you can throw your stone a little further if you've got venture debt in your corner. And the best time to get it is when you're flush with funding and you're kind of at the apex of this funding cycle. We really are kind of like the VC chasers. Like we come in, there's a big serving of venture capital, and then we come in and we can flank that with debt. Why is that good? Well, I mean, I think it gives you more time, and it hedges against uncertainty. So if stuff goes wrong with your fundraising plan, or you can't meet your milestone that you committed to your investors, and all of a sudden they're like, oh, wait a second, that second tranche you can't have, those kinds of things. So it's a way to, almost like an insurance policy that helps smaller companies grow. And I've got 5 or 6 slides later on in the deck that punch into more detail around venture debt, but I just thought I'd tee up, obviously, why you're here. So why come to SVB? So it's an oblique sales job here. I do work in sales, so it's important to me to make sure I convey this correctly. But our bankers really are actually, a lot of them are like ex-entrepreneurs, ex-builders, ex-YC, ex-Techstars, ex-500. So we have a ton of people that have been brought into the bank they've come in from the ecosystem. They're operators. They aren't just like a very stodgy, wearing a suit banker writing you a term sheet. Okay, they're going to get how you're building your business. They actually are probably familiar with the pains of founding a business and all the things that get put on your shoulders. Now, I think positioning SVB, I think, for those that understand how a bank works, right, we get deposits and we can loan money out based on that. Really cheap cost of funds, and in order to do that, our credit folks keep us safe. So that's really where there's this tension between the gentleman or the lady that you'll be speaking with at SVB will be very motivated to kind of get to know like Sunir's company, get to know the ins and outs and who you're plugged in with, who your investors are, how they can help. But on the other side of the table, there's going to be a credit officer that's going to say, I think this is good for Sunir right now, or this isn't good for Sunir right now, and work it out kind of from a credit perspective. It's a part of fintechs and alt lenders, they're running into this full bore with how hard that is to get credit right. But at SVB, we have amazing credit officers. I like to think they're almost like prescient. They can predict the future and kind of keep us out of trouble, help us loan to startups. And I just want to say too is just quick show of hands. Before you walked to the room and saw this dude on stage, how many of you guys have heard of Silicon Valley Bank? Okay, that's really flattering. I'm like, okay, so we're obviously doing a better job of getting our brand out there, and we like to think of it as, we're a nice indicator of quality in terms of how far you are in your journey. So, it's a nice smooth curve. Again, we come in and, we're a bank, so our business is knowing and managing risk. And you can see here these are some of the kind of focal risks based on your life stage. So we talked about kind of who's early on. At the start, I mean, you're just getting your tech built and looking for market fit and trying to get the right people hired and stuff like that. So I think those early stage builders are the ones that need the most help because there's the most common stuff. Like, do you want to be wasting your time doing like HR drudgery or building your product, right? Like, I think you should build your product and make money because then we can loan to you. So that's really why we do what we do. And we're very good at it. And later on, when we get into when you want to scale and like hire those 3 extra sales teams, deck them out with credit cards and have them like travel and start spending, upping your ad spend with Google and all these things. Like when you're in that scaling stage, that's where it really gets interesting because you're Series A, you've got a nice valuation, and typically we come in and we'll take like a very thin piece. I think typically it's like 50 to 100 basis points, somewhere 25 to 100 basis points as a warrant against your the loan, and the interest rates are much better than kind of cash flow or AR kinds of securitization. And then obviously when you're getting ready to IPO, Sunir actually, SVB for a brief time actually had an investment bank about 15 years ago. It's just too much, too far to span, but we do try to take you guys as far as we can, and we've got kind of syndication capability for those that are in larger companies. But this is probably more for your finance team, so I'll zip through this. Okay, sales folks, how many of you, show of hands, have been sucker punched by a compliance person during your sales cycle? Anyone here been kind of security or compliance have completely stopped your sale? Yes? Okay, so I see, okay. So it's a common pain point, and I just like to educate builders on the merits of having proven security milestones or privacy, kind of proof you're in compliance with privacy policies. This stuff's getting real because I don't know if you guys know, but like the fines for this GDPR thing, it's 4% of global income. Like that's like making Google and Facebook scared. So you can imagine that early on you don't want to be facing some horrific lawsuit, and us as a bank, if we use your product and we're exposed some form of data breach and found to be perhaps you're using the data in a way that we haven't authorized you for, and we're fined, that's ugly. So I think anyone who's working, how many guys would say you're in kind of more of an enterprise B2B sales role? Anyone here like enterprise? So what's your product do?
We integrate different platforms with each other, automate sales.
So you're constantly digging into like the sensitive systems of different companies to help them do that. So I think, you know, if I can impart any wisdom on the sales cycle, it's just there are some acronyms, things like SOC 2 and ISO 27001. They're kind of the magic letters these days. Like I look at platforms and I see the little brands and they've become much more prolific. 10 years ago, I used to try to put together like a sales deck at my consulting company I was at to sell those kinds of services, and it was tough selling. Now, like everyone wants these brands on their site to kind of make it easier to sell their product. So, yeah, let's get into brass tacks around getting ready for venture debt. So, first order of business, set up a real accounting app. Talk to Herman if you want to at least get your foot in the door, you know, on a small, inexpensive accounting app, or Steven. The folks at Xero, I think, do a really good job on that. Obviously, getting everything accurate and trustworthy in the system, that's vital. And when you can, look for a real temp CFO, or ultimately, when you're getting, you know, larger amounts of money, the investors and the bank will want to see that you've got a professional CFO. That's the interface. That's who we talk to. That's who lenders have to negotiate with and make sure everything's in order. Make sure you're kind of living up to you know, fancy words like covenants and just doing what you're supposed to do, meeting your milestones. It's like 75% the same as an investor, but with a slightly different lens on. Okay, a few warm-up questions. So I'm a math geek. I like to say that, you know, every time our lenders are sizing up a company, they're running equations in their head, and really they want to answer two questions. Like, should I lend to these folks, and what is kind of the quality of the team, and are they going to get another round? Are they going to continue to raise and kind of continue this virtuous cycle up until IPO or acquisition? And these are some things I like to look at, you know, when I've looked at companies and sized them up, and I typically, you know, I'll jump in as a mentor or decide to help them on an integration or just do something with the bank there. And so I like to think of it as like it's like a force thing, and if you've got good investors, they attract other investors. That's just kind of common sense. But the execution abilities, that's really kind of like what a team thinks they can do. And reaching the milestones, that's what they actually do. So getting that right, when you actually prove, hey, I met that, I said what I was going to do, and I did it. Okay, that's really important, and that differentiates, I think, what, you know, strong founders, strong teams versus like average. Another equation. So second thing, will I get paid? Will I get my bonus? Will ultimately the bank recoup its funds and hopefully some revenue on the warrants? These are ones I use. I mean, I just use like, you know, how fast is your monthly revenue kicking up? It's almost like a, you know, it's a calculus equation. It's a rate of change, an acceleration type of function. Our group that handles companies north of 10 million in revenue at the bank, it's literally called the accelerator group. So you can kind of get the feel for, you reach this point where you're ready to hop into this accelerator and just jet. I think also too, creating enterprise value. So when you're actually like, you know, positively, you know, able to demonstrate that your product is getting better, companies are willing to pay more for it, and you're actually selling it. So creating kind of a multiplication factor of how quickly you're spinning up value, because you're burning money all the time, right? So if your value curve is ahead of that, you're ahead of the game. If your value isn't growing and you're still spending, then you're just going to run out of money. Hate to be so callous. I think also too is how much do you make for your clients over the lifetime, and then how much does it cost to get them? So just looking at those metrics are important for bankers. We play in two spaces. Obviously, we'll do kind of conventional commercial debt, which is more structured against cash flow or accounts receivable, things of that nature. But venture debt's really why you guys are in the room and what we specialize at. Here are some other just kind of you know, overviews of kind of the difference between commercial lending out there. There's the conventional kinds of things that are against things on your balance sheet, and then there's this venture debt piece. You can see some of the timeframes involved. Things that are important. If you want to pay later, like that's where you really need to know the companies. You need to know, are they going to pay up front? Do they need this for something short term? Do they want to pay on the way out? You know, what do we think they're going to exit at? Because we're estimating what the payback will be in terms of the warrants, ultimately if you're successful. And that's where it's very nice to be joined in purpose with your bank in terms of your success, because it's, you know, we don't get, you know, that kind of the nice return on the warrants if you guys don't have a liquidity event and end up doing well for yourselves. So here's actually some good stats from a couple of our crew from our analytics and insights group. And this is stuff that we've crunched based on years of data. And you can see really the sweet spot for us is kind of that Series A round. And we've actually kind of doubled the size of our team that engages in the Series A and below area. And this is where we brought in people from industry, entrepreneurs and residents to kind of beef up how we engage and kind of understand what's going on with these companies. The kind of the ratios involved. So if you've got like a a 50 million valuation, and you're raising Series A or somewhere, that means these are the ratios. These are actually the medians. So higher or lower, but being plugged at 8% on a 50 valuation is kind of a very common pattern. And you can see how kind of trends down when you get larger. That's why I think our sweet spot is really before you're on that happy upward runway. Okay, so that's kind of venture debt in a nutshell. Some of the things SVB does around that, and I thought I'd just leave a little time for questions, or you want to double click in any areas that are of interest to you guys as selling SaaS, building SaaS, those kinds of things. Sunir?
It's a question that I asked you before, but I think it's a good question. So a lot of us are biz dev people, but we're asked by our bosses to go look for financing because we're the business people. And so we're not the owners, and it's like often a new idea for us. So what would you say basics for someone who's in a biz dev role trying to raise money, either venture or debt? What are like the top 3 things they should know and what they should do?
So if you're out with your clients, I think that demonstrating that you can get your clients to actually pay you money. I think the freemium model is one thing that it's nice to kind of bait people along with that, but getting them to pay is a bit differently. I think also understanding how to get to the contract, because I know with larger companies, again, closing the deal on the sales cycle I think is really important, because it's all dollars and cents to a bank. It's cash flows, and it's amazing to have these wonderful ideas like our app is going to do this, right? And that's innovative and exciting and visionary, but until you actually get paid, it doesn't count. I think where it's your personal network as well. I mean, at BD folks, you're always out building how can I kind of position and capitalize and sell my product. I should say not capitalize, but sell my product. I think just shifting those same skills into how you show that you are aware of potential surprises for your company. I think that shows a real kind of executive attitude, because if you're holding equity in the company and you can demonstrate and convey that you're invested in its success, like that, passion sells. Passion gets loans, passion gets funding, and I think that's where kind of just unleashing your inner biz dev demon, to convey that to a banker. They'll get that. Right? We oscillate in the same frequencies as VCs. And the other thing is, I think, so what else? Yeah, I know. I think the other parts would be, BD to get money. Team up with your finance person. If you've got an accountant, maybe establish a deep rapport with someone who is like a solid Northern California-based temp CFO. You could come in and maybe you're not the CEO, but if you're kind of leading the sales charge, you've got the revenue side of the house covered, right? And that'll be really interesting to just showcase to your through an accountant's eyes. If you can show, hey, sales here and show positive revenue, and correlate it against it only costs us $2 to get a lead, and I can make 15 off of them per month, whatever the numbers, I think. Yeah. But use your quant. And your charisma.
So you talked about, So you talked about companies which are getting venture funding. What if we don't have venture funding? We are profitable. How do you do that?
Let's see, in that model, all the ideas of following the VCs as the indicator of quality go out the window.
Right.
So then I think the areas that we ourselves we'll size up some of the factors I mentioned. your likelihood to succeed and how, at what magnitude you're likely to succeed. We do a lot of stuff with corporates. Like we see companies that never took a dime of VC money, all bootstrapped, and then they reach a point where their personal reserves maybe tap out, and they may actually want to then just find another way of another source of funding. And you don't always want to have to bootstrap yourself or tap that one person that's like kind of the bankroller, if you will. So I think there's different success patterns that we've seen over the years, and there's not a need for a VC. I think from a venture debt construct perspective, when the VC is helping to kind of guarantee passively that you're good for it and that you're going to succeed, that can be simulated in other ways. Like there are other ways to solve that particular part of the equation. Like the risk of capital, if you can solve that, the risk-adjusted return on capital, RAROC, if you can solve bankers' problems for them with either alternative solutions or through good financial planning analysis, good instrumentation on your how you're doing, if you make that easy for a banker, then you solve that problem for them. So I thought just a couple approaches. Tactics.
So how do I go about doing this? I have a Silicon Valley Bank account.
Yep.
Who do I talk to?
So you want to you have an account with us, and
yeah.
Let's see. If you don't, well, what do we? I can get offline. Like I can hook you up with the right. I need to know how big you are and what sector you're in and some other details. But happy to facilitate.
Sure. Thanks.
Other questions?
And it's kind of pivoting or extending from his question. Do you need an exit? If you're taking a look at a company like that where they're profitable, they haven't taken a dime, eventually they've totally bootstrapped it from self-service founders. Do you need an exit to invest? Or are you in even if there is no clear exit path, whether it's an acquisition or an IPO or anything like that?
Yeah, I think the hopes are, I mean, we are a bank, so we can help a company like as you grow, and we can do all the things that a normal commercial bank would do. So there's that part of it as well. Like, yes is the answer. And we've recently, I think, I want to say the last 6 years, we've been fighting an active battle against, like, they can't help us. We're going to outgrow them, and we hate that because, like, we build these bonds, we help a company up from early stages, and then they go off and sign with a competing bank who get all like the foreign exchange revenue and the other things they can do. We can do that stuff now. So I think it's more just venture debt is so tailored to kind of this kind of VC ecosystem.
Ladies and gentlemen, we're about to change speakers in room A and room B. We'll have Trillo in room A and GE Healthcare in room B. So please find your way to either of those rooms. Thank you.
They know where they can help and where they're just going to lose, and it's not going to be in the client's best interest. And of all, we're pretty honest. Well, we are an honest bank. I shouldn't say any other things, but if it's not in the best interest of the client, we're not going to like give you something where we know we're not good at it. That's kind of the just. I'm not answering your question properly, I don't think, but I think it's the venture debt isn't the be all end all, I guess would be the short way to say it, and it's all about fit with your company's needs and where you are and what you're trying to achieve too. That's one thing. Even if you're not VC backed, we have our own SVB capital. So I mean, maybe we take an investment in you. I mean, there's ways of striking up interesting relationships with companies that don't have the historical quality signals from a VC or kind of a known investor.
Looking for investment.
But good questions, yeah. All good?
There's no more questions. Well, maybe there's. What are some of the sectors that you're looking at that are most exciting? Like where are you? What are the next 3 years? I'm not even going to go 5.
Yeah.
What are some of the trends you're seeing in the market that might influence or help the folks in this room?
I think for me personally, and also just where I've seen some successful bits, obviously kind of the API space, so API gateways and stuff. Some good exits there, and we've been part of some of those. I think kind of RegTech has come a long way. I think applying applying machine learning to compliance problems and things that are just very arduous and manual. I think finally banks, large FIs, non-bank financial service companies have woken up to the fact that maybe they should automate some of that drudgery and apply data science techniques to look for bad things. As a bank, you're constantly on guard against, whether it's people trying to, hack or somehow get into your bank ecosystem. So like if we let in someone who's on the OFAC list, that's terrible. If we don't file a SAR in a periodic, certain period, we get in trouble. So there's all these compliance back-end things that are still very manual, but all they are really are humans running a set of compliance regs. So if you can just get that into regular expressions and kind of a big data model and just make it defensive. Cyber's been around for a long time, and that's kind of the more conventional perimeter and all the things that go around defending enterprises and things like that. But I think at the business process layer, I think in the cryptocurrency area, that's an area that it's red hot. We don't. That's a very cautionary area. But I think when you're moving money between two places, I think that's also kind of drumming up demand for a lot of the conventional bank technologies, because you see companies coming in and it's like, well, I'm not a bank, but I still move money. I'm a money services business, and I still need to make sure I don't pay bad people or let criminals into my ecosystem. So things like KYC and truly knowing someone's identity. I think there's been some acquisitions by a couple large corporates around like digital identity verification and things of that nature. There's been pros and cons to holding your phone up and going like this and saying this is me. But I think banks have fundamentally always been around in the business of kind of we don't make anything. We don't add value other than to help money get to the right places. And so I think that's where we cover everything from life sciences and all the way that people are using human genomes. There's a whole creative ways of looking at applying new medical devices and stuff. We have a premium wine business. We're all over the board in terms of just other things. But I think on the tech front, those are a couple areas that I like.
Thank you so much.
Thank you, guys. Thank you.
Big round of applause. Thank you.